Welcome back to episode 5 of Road to Profitability. This one is going to be about liquidity in general, liquidity pools, liquidity sweeps. We're going to get into all of that. What is liquidity in the marketplace? Let's hop right into it. So what is liquidity? Liquidity is the degree at which an asset, so the stock market, can be bought or sold in the marketplace without affecting the asset's price. Didn't mean to write that in all caps, but here we go. So what do you mean by this, Chris? When the big banks, when these big institutions, the smart money, want to put in orders to the marketplace, they can't just sell wherever they want. They can't just like wake up and go, I wonder where to sell, and just sell, because the market will just absolutely tank. They can't do that. They can't buy in because the market will absolutely pump and they'll just get a bad entry. And there's actually not enough orders in the marketplace. So let's take it back. Before the marketplace was online, before there was this central algorithm, the marketplace was done by physical stockbrokers on Wall Street. There was a physical stock market. So if you wanted to buy one share of Netflix, one share of Steel Incorporated, right? You would have to physically go and buy a piece of paper from the broker, and that would be your share of the company. And to get that piece of paper, to get that share of the company, somebody would physically have to sell you that piece of paper. Right? You can't just buy a share whenever you want. There has to be a seller in that exchange. So that somebody has to sell you a piece of paper, you have to buy the piece of paper. Now it's on an algorithm, so the second you hit buy, somebody sells you one. The algorithm will match you, it'll pair you with a willing seller. This is a perfect analogy. I just want to find really clean ones for the YouTube video. Banks want to buy in. They want to get in a long position. They need people to sell them their positions to get in long, because they have so many orders, they can't just buy in. So for this example, people see this low, they buy in, and then have something called a buy stop. So once price goes below this low, it's their stop loss. They'll stop buying orders. So these buy stops are below these lows, right here. Buy stops. These lows have buy stops. Buy stops, right? So right when price gets below these lows, these unknowing buyers, these people who are buying in an uptrend, will be stopped out, because this invalidates their idea, and they have to sell. Their hand is forced to sell these orders back into the marketplace. It is here, under these buy stops, where the banks now get to pair their multitude of orders into the marketplace, right? So under these buy stops are where the bank are pairing their orders. When they get sold to, they buy in. And this is what causes the market to run like this. As I told you before, the market, now this is gonna go with all of our other lessons. The market will manipulate and clear orders and induce people into shorts with a strong buying pressure, so the banks can pair their orders and buy in. The algorithm is designed for the big banks. Just like, again, I showed you consolidation era. This is to formulate orders, right? Going back to our last lesson. Consolidation. Orders here, orders here, orders here, orders here. Specifically building sell orders. You can see here, buy stops, buy stops, buy stops. They run the low of this consolidation, an expansion out of this, and then they reverse price. Right? Now what are they targeting? Well, if you look over, what are the most obvious highs? This one and this one stick out to you the most. Or at least they stick out to me the most. So let's drag these across and see what happens at these highs. You can see right here, right when we get to this high, we do a little retracement back down. This is the banks selling off their orders. They have people above these highs, because like we said before, there's people selling, and once they get back up here to this high, they're forced to buy back. So right, algorithm pushes price below this consolidation, forcing people to sell to the banks. Then once we push above this high, the people above this high have sell stops, and they're forced to sell to the banks. And these people shorting, the people shorting above this high, are forced to buy back their orders where the banks sell it. So the banks get in here, sell off here at liquidity pools. This is how the banks move. They move from liquidity pool to liquidity pool, right? And this is the foundation of smart money concepts, is big whales, big banks, smart money, institutions, central banks buying below lows, selling above highs. And this is what we want to follow as well. Whereas the normal retail trader, the person who doesn't typically trade ICT concepts, will see this as strong selling pressure. They will be induced into the marketplace thinking we're going lower, we're running all the way down here maybe. So they'll get in, maybe their stop loss is here, thinking we're going lower. They're used as liquidity to pump the markets higher because they buy back those sell orders too. So they induced orders short, and then they cleared orders, giving us the opportunity, or giving the banks the opportunity to go long. And if you are in the know, it gives you the opportunity to buy below this low and sell off at this high. And that's basically all we're doing. Before we get into all the other concepts, this is the basic premise of ICT and how to trade it. So when we pair this with inefficiencies in the market, which is the next video, and something like bias, higher time frame bias, we're going back to the trend. Notice how we have consolidation, expansion, retracement, expansion, reversal. We have our market structure shift right here. Market structure shift, reversal, market structure shift, expansion, retracement, expansion. You'll notice we retrace here on a higher time frame. Not only is it a retracement, we're in an uptrend. Higher lows, higher highs, higher lows, right? Higher highs. So we know we're in an uptrend from the second video. We know the algorithm is clearing orders and tricking people into the market from the third video. And then, holy brain fart. And then we also have the consolidation, expansion, reversal. Liquidity pool to liquidity pool, the IPTA. Right? Clear as day. If you took nothing else, if you stopped the mentorship, if you stopped this road to profitability today, you would be able to make money in the marketplace off of just what I've taught already. However, we have another 20, 30 videos getting more precise on how to catch these moves in the marketplace. And how to have a good risk to reward ratio and how to make money. Because that's, again, what it is at the end of the day. It's making money. Every ICT trader, their model starts with a liquidity sweep. So we go below this liquidity, sweep it, go to this liquidity, sell. That's every ICT trader's. You can have a different model than me. A lot of ICT traders don't trade the same thing, but we do always usually tend to be trading liquidity pools. And you can see this on the daily. The Trump tariffs, they created fear and panic. Everyone thought the stock market was going to plummet. We're going to have this big recession. In reality, we just came in, grabbed these buy stops, grabbed these buy stops. These were already grabbed, I guess. There's a low here, these buy stops, and these buy stops. So we tricked the not us, but the market makers, the smart money, tricked people in fear and panic to think the market was going to have a huge recession. And we also cleared out all this liquidity. We had all these liquidity sweeps. We took all these buy stops. And now the market makers are able to buy in here at a discount for the market and hold up until these highs. So they get in around here, below liquidity. They got in here, and they're going to be exiting at the next liquidity pool. So they probably, some of the positions exited here. Most of it's going to be exited around here and here at these highs. These liquidity pools are what we're targeting. So this is my high time frame bias with the 4-hour and the daily trendward up, making higher highs, higher lows. All right. So that's the basics of the liquidity. This is very simple stuff. And yeah, tomorrow we're going to be going over inefficiencies, these gaps in price, fair value gaps, devil's marks, inefficiencies and price action. All right, so catch you in the next video.